Here we are at the base of a supermarket in the Minhang district of Shanghai, and as you can see, all the shops are shut and there isn't a soul to be found inside the supermarket.
This street was once the go-to place in Shanghai for musical instruments. Let's take a look around now. It seems like there are hardly any shops selling instruments anymore, especially over here. As you can see, a lot of the shops have closed down. Let's check out the other shops on the street. Many of them have shut their doors as well, including a few up ahead. Across the street, besides a bank and a hotel, there's only one shop still open for business.
According to the man who recorded the video, the once highly famous musical instrument street in Shanghai is now only left with a few hotels and office spaces, with most of the other shops having closed down. This indicates a substantial decrease in consumer demand, signaling that the renowned musical instrument street of Shanghai can no longer revert to its former glory.
Countries like the US and others in the West are now shifting their orders to countries like India and Vietnam, putting businesses like ours in a really tight spot.
Due to the double whammy of weak overseas demand and sluggish domestic consumer spending, China saw a decline in both imports and exports in August, adding further strain to the already beleaguered manufacturing sector. The latest data, released by China's General Administration of Customs on September 7th, showed that exports in August dropped by 8.8% compared to the same period last year. This is a slight improvement over the median forecast of 9.2% from a Reuters survey of economists and better than the 14.5% year-on-year decline in July. However, this marks the fourth consecutive month of decline in China's export data. Meanwhile, the total amounts of imports in August decreased by about 7% year-on-year, a slower decline than the 9% predicted by the Reuters survey. This comes following a 12% decline in July. After a brief rebound following the lifting of stringent zero-COVID control measures at the end of last year, China's economy has slowed down and remains weak, attracting close attention globally. Since March, the escalating real estate debt crisis, falling property prices, and wavering confidence among consumers and investors have led to weakened domestic and overseas demand. This has prompted analysts to reduce China's growth forecasts for this year, warning that it might not meet the government's target of around 5% annual growth. Reuters cited an analysis by the chief Asia economist at HSBC, Frederick Neumann, who noted that while the latest trade data is slightly better, trade is still contracting. He added, quote, "There is a bit of a sign here of stabilization, but I think there's still a long way to go." Zhou Hao, the chief economist at Guotai Junan International, stated, quote, "Looking ahead, whether China's trade growth has bottomed out will depend on several factors, the most obvious of which is domestic demand." In recent months, the Beijing government has announced a series of measures to boost economic growth, with the central bank and top financial regulators easing some lending rules in hopes of assisting potential homebuyers with loans. But analysts warn that these measures introduced by the CCP might have limited effects, given the slow recovery in the labor market and the uncertainties surrounding household income prospects. Moreover, China's economic activities are hampered by the zero-COVID policy, and the reduction in household incomes in China is cooling consumer spending, affecting China's purchases of imported products. As a result, China's trade surplus in August plummeted to $68 billion, falling short of the expected $74 billion and lower than the $81 billion in July. Data published by China's financial news outlet Caixin on September 5th also indicated a continuous slump in demand and the inability of stimulus measures to effectively rejuvenate consumption. The Purchasing Managers' Index, PMI, for China's service sector recorded a new low for the year in August at 51.8, a decrease of 2 percentage points from July, but still above the 50-point mark separating expansion from contraction. For the first time this year, the new Export Orders Index for the service sector fell in contraction territory, indicating a significant weakening in overseas demand. Previously released data showed that the Caixin China Manufacturing PMI increased by 1.8 percentage points in August, partially offsetting the drag caused by the decline in the service sector PMI. The comprehensive PMI for August edged down by 0.2 percentage points to 51.7, the lowest since February. The official PMI data released by the National Bureau of Statistics primarily focuses on large and medium-sized enterprises, while the Caixin PMI data predominantly involves small and medium-sized enterprises. The survey revealed that inadequate domestic demand and declining external demand have led to a dip in confidence among service sector enterprises. Although the Business Expectation Index remained in the expansion range in August, it fell to its lowest level since December 2022.
Doing business in the KTV industry is just a nightmare these days. It's 9 p.m. now, typically the busiest time of the night, but there's not a single customer in sight.
The current business downturn has this KTV owner sighing repeatedly. The owner expresses great distress, wondering about the state of business this year and where all the customers have gone. He is unsure of how the restaurant sector is faring. Observing others' posts about their bustling business in the Douyin daily, he can't help but wonder how to achieve a similar level of business success. Contrary to these posts, his establishment stands empty, reflecting the grim reality of the situation.
Business in the food and beverage sector took a nosedive in September. It's not just a significant drop. It's actually hit rock bottom. We used to make 2,000 to 3,000 yuan a day, and now we're down to just a few hundred.
This restaurant owner openly states he cannot pinpoint the exact cause of the business slump and notes the fierce competition in the food and beverage industry with every merchant vying for customers.
Has anyone else noticed that business this year is even worse than during the 3 years of the pandemic? Even during the outbreak, we never experienced such tough times as we are seeing this year.
The man filming the video, a clothing retail shop owner, shares that during a recent discussion with some friends in the restaurant sector, it was revealed that business is incredibly challenging for them. Even offering special discounted meals for two at 39 or 49 yuan, that is around $5 to $6 hasn't brought in customers. The streets seem to have emptied suddenly. He remarked that since September this year, restaurant owners feel that, apart from the mandatory closure during the pandemic, the business has been worse than any period in the past decade. This is an unprecedented phenomenon. Some establishments incur over 1 million yuan in annual rent, yet only make a little over 1,000 to 2,000 yuan daily, making it almost impossible to sustain the business. At the moment, all sectors in China are finding it hard to maintain business. The downturn in the restaurant industry is expected to spill over into various sectors, including clothing. A decline in customer spending is anticipated, making the days ahead even more challenging. He urged everyone to brace themselves for hard times, with worsening conditions expected in the coming years. Economists point out that the situation resembles an economic recession, with young adults facing over 21% unemployment rates, and deflationary pressures eating into profit margins, creating significant economic hardships for consumers and small businesses alike. Senior economist at Caixin Insight Group, Wang Zhe, noted that while the manufacturing sector showed signs of improvement in August, the service sector is losing momentum, with persistent, significant downward economic pressures. The internal lack of demand and weak expectations might create a negative cycle for a prolonged period. This is compounded by uncertainties in external demand, possibly intensifying the economic downturn. On another note, data from the U.S. Census Bureau shows China's share of U.S. imports has dropped to its lowest level since 2006 in the 12 months ending this July. The data released on September 6th shows a decrease to an average of 14.6%, down from the peak of 21.8% in the 12 months ending March 2018. In recent years, due to the U.S. government's push to lessen economic dependence on China and the pandemic revealing vulnerabilities in China's supply chain, American companies have been overhauling their supply chains. Countries like Mexico and Vietnam have benefited from this shift, seeing an increase in foreign investments from China and other countries. As of the 12 months ending in July, Mexico accounted for an average of 15% of U.S. imports, a record high in 30 years, while Vietnam's share stood at almost 4%, slightly below the peak reached in 2022. For several decades, foreign investment has been a crucial force behind China's economic ascent, forming a vital part of its economy. However, mounting indicators suggest a reversal in this trend, with China no longer being a favored hotspot for foreign investors. Recent key investment metrics have plummeted to historical lows unseen since the 1990s. This encompassed a decrease in direct foreign investments last quarter and a surge in liabilities from foreign business investments. World Bank data illustrates a drastic reduction in net inflows of foreign direct investment in China last year, roughly dwindling to levels recorded in 1990. This marks nearly a 50% decrease compared to the previous year. The Ministry of Commerce of China revealed last month that the actual usage of foreign capital has decreased by about 10% year-on-year from January to July this year. In terms of market investments, recent statistics from the Financial Times highlighted a historic peak in the speed at which foreign investors are selling off Chinese stocks in August, disposing of Chinese shares worth up to $12 billion. Despite comprising nearly 31% of the MSCI Morgan Stanley Emerging Market Index, Chinese securities were excluded from UBS Asset Management's new open-ended Emerging Market Index ETF launched earlier this month. This signals the latest instance of foreign investors hesitating to allocate investments in portfolios centered on the world's second-largest economy. John Ramig, a partner at the Buchalter law firm, told Voice of America, quote, "I don't have one client wanting to invest in China. Not a single client. Everyone is looking to either sell their Chinese operation, or if they're sourcing products in China, they're looking for an alternative place to do that. That's dramatically different from what it was even 5 years ago." Ramig, who has been engaged in foreign enterprise investment in China since the 90s, mainly serving American and European firms, finds the recent profound shifts unprecedented in his experience. A few years ago, due to worsening bilateral relations, Ramig and his American partners decided to sell most of their non-high-tech companies' assets in China to a Chinese citizen. He advised against Western companies investing in China now, citing the high risk of significant investment challenges due to domestic instability or other potential adverse developments. In addition to exports, the Chinese government has long depended on the real estate market to strengthen its economy. However, the recent downturn in the real estate market, coupled with sluggish consumer spending and a decline in credit growth, has inflicted significant shocks to the Chinese economy. In the video, the man takes viewers on a tour of a luxury apartment complex in Jiangsu province where prices were 28,000 yuan, around 3,800 yuan per square meter just a couple of years ago. According to the homeowner interviewed, the property was purchased in 2020 for 2.88 million yuan. Now, they are hoping to sell it for 1.88 million yuan, which would mean a loss of 1 million yuan. However, due to the unfavorable real estate market conditions, the asking price has been set at 1.76 million yuan, representing a loss of 1.12 million yuan. Facing soaring debt levels, a deteriorating real estate market, and industrial overcapacity, William Hurst, professor of Chinese development studies at the University of Cambridge, told Reuters, quote, "There is a significant risk in the short term of financial crisis or other degree of economic crisis that would carry very substantial social and political costs for the Chinese government. Eventually, there's going to have to be a reckoning." Analysts say that if the real estate market collapses, it would drag down the financial markets as well. The end of the economic boom era could curb foreign enterprises' exports to China, threatening the livelihoods of millions of unemployed young people and the interests of ordinary property owners in China, thereby posing risks to social stability. Unemployment among young people in China exceeds 21%, and about 70% of family wealth is concentrated in real estate. Max Zenglein, a German expert on China's economic issues, remarked that one of China's greatest success stories has been the creation of a strong middle class. But this is becoming one of its biggest vulnerabilities. If the government asks everyone to tighten their belts, it would be met with considerable resistance. Moreover, analysts point out that the alarm bells for the Chinese economy had rung during the global financial crisis of 2008 to 2009 and the capital outflow panic in 2015. At those times, China revitalized confidence through measures such as stimulating infrastructure investment and encouraging speculation in the real estate market. However, infrastructure upgrades have led to excessive debt, and the bursting of the real estate bubble now poses risks to the current financial stability.